stream supporter, Vantage. Vantage allows traders outside of the United States to trade CFDs. You can trade everything from commodities like gold, you can trade US indices or global indices, and you can even trade FX all under one brokerage, and you can connect to MetaTrader 4 and trade directly on tradingview.com. Not to mention, they also have a really good sign-up bonus going on right now. So we'll drop the link to that down below in the chat as well as in the description of this live stream. Check out Vantage. Now back to the show. All right, and we are back with Chris. What's up, Chris? How's it going, man?
Good morning. Look at that Russell ripping.
Man, it's I was, thinking about what to say as you came on. I was like, is this the new normal? Is the new normal the other guys having a chance at the plate other than just technology? Mainly, you've got the Russell up 2%, the Dow Jones up 1%, breaking to new highs. I mean, it's a different story than what we've had, in recent months. In recent months, it's been NASDAQ only, S&P second place, and Dow Jones like slightly red on the day every day. Like it's been a very different story. So what are your thoughts on all this? You have some Russell positions, right, Chris?
I do. Here is a look at the Russell. I might have to restart my platform here, but my Russell is now up. So if you were on the show with us yesterday, my Russell was up around $6,000. Now it's up 20 grand.
Wow.
This thing is just ripping,
Congrats.
man.
That's awesome.
It's really spectacular. So I'm just going to take a look at an individual account here with some of the Russells. So the add-on trade that I have, a couple things that are doing really well. So I have let's see here. My January 185, I think I'm going to try to do on this one is I've got an August 200 call to the September 215. I think I'm going to look to, I'm going to have to close this down and restart it. I'm getting some glitchy, but anyway, each individual counts up around $3,000 and hopefully more to go. I want to check on one trade. Maybe log out, just come back in, Nick. The 240 to 245. Let me share that chart right here. So IWM. I mean, this is it's not really out of the norm. It's like, look, Tesla did this, Apple did this. I mean, stocks have been doing this, but the fact that we've been waiting, I would say patiently, to see is the small cap going to actually make a rip this year. I just kept watching this as a potential squeeze trade. We had that big rip from Q4. And the reason I was willing to get in and get somewhat aggressive on the timing of this is Q4 of last year, Russell outperformed everything. Okay.
Absolutely, yeah.
Right now, at the time when this thing's starting to go, it's up 2% versus down versus flat. So, I mean, it's clearly on a mission.
You're seeing the Russell and the RSP, Chris. That's the other one I was pointing out just before you joined. The RSP is the equal weighted S&P 500 for those who don't know. And we've got RSP outperformance big time today, 1.10% on the day. Meanwhile, as you mentioned, Chris, SPY, slightly positive, but this is a very new development here recently. The RSP actually leading the charge. And one way I like to break this down, guys, is that if you were to take the 500 stocks that are in the S&P 500 and put equal amounts of money in each one, that is what the RSP does. So the RSP puts equal amounts of money in each stock, whereas the S&P 500, the default way is it actually puts, the heaviest weightings in the biggest companies. So a lot of weight goes into Google, Amazon, Apple, Nvidia, and a lot less. But imagine if you took these same 500 companies and you put the same amount into each one. I know it sounds like a little difference, but it's been a huge one this year where the average company has not been doing particularly well. But the heavyweights, the big ones, have been doing really well. Now we see a rotation, a change in that story has been now the average company is starting to pick up speed, and it's actually outperforming right now the weighted index. So I don't know, Chris, do you think if you had to pick a side on that, do you think that is set to continue? Like RSP and Russell, let's say you could only be long one, you had to be long one for the rest of the year. RSP or SPY? What do you think?
RSP or SPY? Actually, can I throw another one in? Look at the IJR.
IJR,
Yep.
small
That's
cap ETF.
your S&P small cap.
Okay, okay. Yeah.
So I
Maybe
think
choose
that
this
that's
one
going to
too.
be so. If I'm going to be long one right now, here's why I like IJR, and here's why I like IWM. Okay,
Mhm.
IJR, it's to me, it's the measured move at least to get back to the previous highs. RSP is still sitting at all time highs. SPY is sitting at all time highs.
Mhm.
QQQ is sitting at all time highs. Right now, the catch up trade that I think is pretty attractive is getting back to these all time highs. So
Yeah.
IJR still has, I mean, we've ripped about 7.8% in the last week since this rotation happened on Thursday. It's up right around, yeah, 7.5, almost 8%. And, what I want to look at is, let's just say from current price to revisit the highs, there's another 5 to 6% right there. Now, that might not sound like a lot, but an index moving 5 to 6% is pretty big, especially doing it in this short amount of time. If you go to the IWR, you and I talked about this well before this move happened. It was just a matter of, if we have confirmation, and I had mentioned this ascending wedge, if we have confirmation of this thing breaking higher, we've got a lot of upside here. There's 20+%. And, with I'd say smart money and this confirmation happening, there is a race to get to those all-time highs. So
Yeah, I
I'm
mean,
hoping I'm
Chris, I mean,
right.
it looks like that thing might just make a run for it. I mean, there's nothing stopping this IWM chart. Another way of looking at it is RTY for those in the audience. RTY is a futures, very clean chart representation of the Russell. And what you can see is, look at this. I mean, just as Chris was pointing out, end of last year, you had a really sweet spot scenario where it was like yields were coming down. They thought they were going to see rate cuts, but the jobs market was rock solid. It was like, oh, Russell to the end. I was bullish during the Russell on the Russell during this time. I am watching and applauding you and Frank for being in this move, but I am not in it myself. My thought was, I'm concerned inflation was staying too sticky for too long, and that
Mhm.
growth might get hurt in there. And I think there's still a possibility of that happening, but most likely right now the market is just saying, look, rate cuts are coming. The jobs market's not crashing. There's going to be a growth cycle, and the Russell is back on top. And for me as an onlooker, it's like I'm interested in pullbacks, but I'm also fully aware when this thing makes its moves, it's
Yeah.
hard to find pullbacks.
Yep. I mean, at this point, with this type of velocity we're seeing in the last, 3, 4 days of trading, a flag might be all you get.
Yeah.
You might
Yeah.
get a bull flag, you might get a pause for a day, but I mean, if I'm looking at my breakout point, I mean, if this comes back to this level in any way, shape, or form, that's a chance to buy it. But just look, there was very little to do here outside of get long and stay long. I mean, I had some debit spreads that were paying pretty nicely. I had some calls that were paying pretty nicely, and I traded it. I mean, and again, structurally, it was at support. This is a pretty easy trade to see, like the Q4 rip, and there was good profits there. But look, I was lucky to make some good profits there. I'm fortunate that I didn't get overly bullish going into this year, because had I been overly bullish, this would have beat up a lot of my long positions. So what I did instead is I opted for, staying out of the way, doing some credit spreads, doing some ratio spreads. And then I have some longer plays. I mean, I essentially did some leaps on the Russell to say, look, I'll give you the year, get to December, get to January, see if this thing wants to go. And so I
Yeah.
had those positions waiting with, the intrinsic value that I paid for, but now we're getting the real kind of burst to the upside. And
Yeah.
probably
Yes,
I will take
the one thing I did right with the Russell is through that whole chopping period
uh
that you've got on your chart, like 2023. I was selling puts, selling covered calls. I played that sideways market pretty well. What
yeah,
happened was I sold puts into that September October sell off that you've got on your screen there, right, the right side of your circle. Big sell off starts coming in. I get assigned puts. I've got exposure to the Russell, like you're saying, so I was buying in there.
yep,
Thing is, I sold a call too tight and got out of it way too soon. But can't complain. I sold for some premium in there. On my account, I made some nice positive gains just selling premium on the Russell. But I gotta say, I mean, I think you look back at this time, Chris, in 5 years, and you say, what were we doing? The Russell was so undervalued relative to the S&P 500. I think there's a lot of room for small caps, and I've said that for, my thesis going into the beginning of the year, Chris, was like Russell is my primary play, and that changed for me too. I think you mentioned, kind of changing thoughts a little bit, changed big time for me. I was like, I don't know, I'm leaning more towards gold because I don't know what's going to happen to the economy now,
Right.
but I still don't know what's going to happen to the economy, so that's why I'm still got some TLT and gold positioning. Otherwise, I would be fully Russell. So I'm
Yep.
a little bit foot in both camps, but yeah, really nice pop for the Russell, and we'll see if it continue. Gold keeps making pushes. We're back up, Chris, to all-time highs for gold. What are your thoughts on this?
Well, I look at this from a wave structure. We could be on the cusp of this wave 5 really getting some traction. So if this is wave 1, 2, 3, a lot of times for wave 4, it's typically a pause. If all this is a pause, then this pause is in, and this breaking to fresh all-time highs means we are going to see wave 5. So, I mean, if we're clearing 2450, 2460, I've got this resistance at 2470. I mean, if we're drifting higher and there's nothing really stopping it, I'm still going to be buying gold on pullbacks. So,
Yeah.
again, wave 1, 2, 3, 4. If that's all it was, is that little sideways movement for the kind of 1, 2, 3 sideways, and we're going to go wave 5. I mean, the hard part is wave 5. I'd say that's my measured move right around 2800. But the best thing, and typically what you do, is you're long, and you're just trailing stop losses, and you get a lot of extra upside there, as opposed to trying to choke it off too quickly. I feel very lucky in gold that I removed my caps last week, and I mean, I don't know what the urge was outside of, we started to go from these recent lows back up a little bit. I'm like, you know what? If we're going to retest these highs, I don't want my calls to get too tight. I don't want my calls to be kind of underwater. And GLD that I own, I mean, I had calls at 230, 250, and 235, and right now, like, those don't seem like they're threatened. But going out maybe another month, I mean, if my expiration was in August or September, and all of a sudden gold's up to 231 or 232, all of a sudden my calls are now negative. My calls are capping profit. And so I actually I collected about $1 on my credits, and I closed them for about 45 cents. So I mean, I took about 50%, over 50% of the profit on my call, got it out of the way. Now I don't have it covered at all. And I don't intend to have it covered right now, because if this is going to
Yeah.
run, I want to stay out of the way.
No, I'm kind of in the same camp. I've thought about that too, Chris. I'm like, okay, we're making a nice move here. Do I, sell a month or two out, call, and just kind of like sit pretty on it? But the thing about gold is it's not, it's such a interesting asset class. It's so unique in the sense that, gold can go 10 years and be the most boring. You might get 2% out of it a year.
Hmm.
But then when it makes its moves, it's very much like, this is like the chart of gold over like a long period of time. It's like this, like it is almost like a trend follower's equity over time is like what gold typically does. And
Right.
I think that, when this move is finally happening, which I think we are seeing right now, trying to call that into sight, it just moves so parabolically in one direction when it really wants to make moves. I mean, look at, and it's been a minute, we're a bit overdue, in my opinion, for a substantial breakout like what we saw. Here's 1977 up through 1980. We saw massive parabolic runs in gold. You saw it in the 2000s into 2011s. And think about this, Chris. During this time, had you bought the S&P 500, you were flat after 10 years. But in gold, you had 600% gains. Obviously, I'm cherry picking the bottom to the top. But the point is, there's these periods where you want to let that gold, monster run take place. And I think that 2020 triggered maybe another cycle for gold. Maybe we are also, I think, are you paused, Chris? I think we might have lost Chris. I don't know if he can hear me. He seems very still right now. I don't know. You guys seeing the same thing I am, or is it me? Maybe I'm frozen. I think we might have, he's back, I think. Can you hear me, Chris?
It might be me. Can you hear me, Nick?
I can hear
A
you.
second.
All good. We'll get it sorted out.
I'm back.
Yeah. Okay, I think I can hear you. Chris, maybe just back out and come back in. That might be the fix. Anyways, so what I was pointing out, oh, he's back, I think. Yep. Oh, you're muted.
Oh,
there you go.
I'm okay right now.
Okay, yep, you're good.
All right,
you're
I'm
good.
just gonna. I've got too many applications running here, so I'll just get back into it. So I missed some of the segment on your gold run, but look, gold is looking pretty attractive. Look, Bitcoin's made a big recovery in the last couple of
It has, yeah.
weeks. I mean, Bitcoin played out pretty well with a. I kind of called this. I'm kind of happy with it. Bear trap, right? I thought this is a good opportunity. If the bulls are around, it's a bear trap by testing this low and testing this pocket, and that's precisely what we did. So I have some positions where my my BITOs, my IBITs, I didn't trade Bitcoin futures. I actually talked to the Tasty Trade team last week. I was looking at some micro Bitcoin and micro Ethereum. I couldn't do options on those. I could just buy the futures contract, but I'm talking about this right before it broke the trend line, and I was like, well, if I'm wrong, then this gets pretty heavy-handed to the downside. So I wanted to do an option trade, but I could only do it on regular Bitcoin futures, and they're 1,000-point wide spreads, and I wasn't about to take on like, hey, if I'm right, I'll make $3,000. If I'm wrong, I'm going to make lose $3,000. That's a little too much out of. So long story short, I mean, BITO is a ProShares ETF that you can trade options around. I've been long on this one from the rips in here, broke out, and I pretty much held it. So when we came back to this level, I bought some more. Came back to this level, I bought some more. So I have about 3% between BITO and IBIT in my portfolios. Personally, I have closer to 10%. I mean, I'm good with like a 10% allocation personally to Bitcoin. For my
Okay.
about 3%.
Dang, that's pretty aggressive, Chris. That's a believer right there. Are you a crypto guy? I didn't realize you're that much of a crypto guy.
I'm not, but it's risk capital, man. I mean, if it's 10% that can make a portfolio, go up to, I don't know. I mean, in the next, like, think of the rule of 72. If I have an asset that's going to make 100%, 200%, and again, if I'm looking at longer term, and this is way out there, but I look at it this way: we're trading at $63,000 right now. Okay, $63,000 right now, and if we get to $1 million on Bitcoin, and this is a wild, ridiculous price, but that's what maximalists are talking about. So if we went up 15x over a 5 or 10 year period, what's that risk capital look like for you? If I've got 10% allocated, all of a sudden I'm up 15 times that. Like, that's a lot of performance on one asset that's basically controlled risk. I mean, can I make 10% a year? Yes, I can find a way to do that. So I look at it longer term. It's like it's okay for me.
Yeah, I think I like that's the thing with Bitcoin that's interesting to me as well, is like the potential alpha there, the potential like substantial outperformance that you could add to your account. 10% is aggressive, but to your point, I mean, how do you outperform? How do you outperform? You find things that have really good skewed risk to reward, right? And I'm with you on Bitcoin. I mean, I think that I see a world in which more adoptions of Bitcoin become more of a thing, especially now, to be honest, where it's not as much of a anti-dollar thing because of how much regulation has come into the picture. Is it a technology that could be, just used as a very traceable money? Maybe so, so there's without even speculating, though, it's just like, it's an asset that has a really strong track record. Clearly people want Bitcoin, they want to buy Bitcoin, and that's almost enough, I feel like, for trading. And to your point, you still, your downside, and you have to be willing to accept. For me, I think, I've mentioned I want to have like a 2 to 3% allocation of my portfolio to Bitcoin. And that's willing to say, like, that 2 to 3% might go to nothing, but then other areas of my account might do much better. So yeah, no, I think having some allocation to Bitcoin, for me personally, is also again, I don't know the future, but I feel like there's a clear track record of Bitcoin being this monster that keeps coming back and keep pushing higher. And so purely off of like, well, look at history, the risk to reward is not bad here. It's not died in the last, 10 years that it's been around. So
Right.
I feel like I've said this a lot of times to Frank, and I have talked about this a lot. Every time Bitcoin goes down and comes back up, and every year that passes that Bitcoin doesn't go to zero, I think it's like spreading its roots further into the forest. It's becoming more rooted in the financial world. So I don't know. I feel like the risk reward gets better over time.
Oh, well, I mean, I've said it's risk capital from day one.
Yeah.
I think the one thing that was a little nerve wracking over this recent, let's say month or so, has been this kind of Mount Gox supply, and all of a sudden having like another, I don't know if it was, millions of Bitcoin coming back online or adding to supply, and that's why the price was dropping. But right now, I do think this little rally, it shows a couple of things. I think it shows that the bulls are still around. I think it shows that technicals matter. And the next phase of this trade is, if this is, I mean, pretty strong support. Like I said, a bit of a bear trap and fake out trade. But if this bear trap all of a sudden produces some type of bull flag pattern and we're back up towards 74K, I think what's going to be potentially exciting, and I talked about this in my earlier session this morning, Nick, think about how much more clear the market can see right now, right? The market can see that Fed rates are coming more than likely, like very likely, okay? And the market can see who the president's going to be more than likely. So all that gray that we had a couple months ago, all this murkiness and uncertainty, I think the market has that song playing in the background, like, I can see clearly now.
Yeah, no, you're so right, Chris.
So,
And just to add to that about the presidential election thing for everybody in the audience, Chris is not even stating his like there's none for the market to just say whether it was going to be Trump or whether it was going to be Biden. I mean, still there is some uncertainty, but having a more clear picture of who it likely is gives the market the uncertainty. All you have to know is markets hate uncertainty. They hate not knowing. When the pandemic broke out, it was like, how long is this, recession, or how long is the market going to be shut down? How long are business going to be shut down? People hate uncertainty in the markets. But even if you know it's going to be Trump or it's going to be Biden, if you get just a solid knowing, I think the market rallies on either one. Not just because it's Trump, not just because it's Biden, but because now we don't have to guess and try and like fumble around with what are we going to do in which case. Like, you now have the cat out of the bag. So yeah, very good point, Chris, but didn't mean to interrupt you. I just wanted to add to that because that's such a good point.
No, I think that makes a big difference because, and partly too, it's like, it's interesting how we've been making, and I want to say we've made 7 all-time highs in 7 trading days, by the way, which is insane.
Yeah.
The type of volatility that we're seeing this year thus far has stacked up to be roughly what we saw back in 2017. The exception being 2017 didn't have a single losing month. This month, or this year, April was the only pullback month we've seen.
Yep.
Look, I still think the cycle's a bit long in the tooth. I think the large cap might underperform small cap because if money's going to go towards undervalued, it's small cap. I mean, and I don't know if it's necessarily value. I mean, one of the best things might be small cap growth right now. Let me see if we can find that here.
IWF, I think.
Small cap growth.
I think it's IWF.
Well, that's Russell, but there's isn't there an S&P?
Okay,
yeah. Let me see. It doesn't matter, but IWF is Russell growth top one. Yeah, that's fine. So IWF. I mean, the daily time frame doesn't look the same as IWM. I mean, it's but IWF has already blown the tops off. So I guess I'm looking at this S&P small cap value. Let me see if this is so Sly V. I feel like Frank is in this.
Frank has Sly G.
Sly G.
Yeah.
You sound dirty, man. Some Sly G.
He loves saying the name. He's like, take a look at Sly G.
Dude, Sly V is up, and Sly G might be in too. Be sliding in everyone's DMs here in a little bit.
Small cap growth ETF.
Yeah. So if we go from here to the highs, I mean, another 7 to 8%. Let me just go back to the IWM. Man, it's like it's a beautiful thing to see this thing ripping. I mean, that's crazy, dude. I'm up another like, $12,000, $13,000 since yesterday, just just by participating in this move that was pretty safe and out of the way, and it was just kind of hanging steady. It's like, well, ratio spreads, credit spreads out of the money. Those are all looking to pay really well, and then getting a bit more aggressive on this confirmation. I mean, we're sitting, and this is where I think the potential catch up is happening. 11% from current price to get to the all-time highs in the IWM. That's a pretty good catch-up trade for an index. And
Yeah,
could it blow through that? Maybe. One thing I wanted to bring up, the actual like PE, the price to earnings ratio for the S&P. We're at some levels where it's getting a little frothy out there in the S&P. I mean, we're trading around 25.8, and I just want to throw a couple of numbers out there. So last time we had, the big peaks in the PE ratio for the S&P, as you can imagine, 2020, we're up to 30.7. Crash happened with COVID. I don't think COVID was really the reason. I think it was just the uncertainty around it. And all of a sudden it just took the market by storm. But obviously we bought our way out of that. But 25.8 is where we're at right now. Okay. 26.7 was 2008. That's right up there. We're really close to that. The 1999, 2000, 2001, 29.3, 29.6. So price to earnings ratios, where we are right now, this is a really critical earnings season. So as I said, it's nice that the market has a little bit more clarity around rate cuts and more clarity around the presidential election. The one thing the market may got a little ahead of itself on, and all I'm doing is making a case for if the market's not going to just be up forever, for the rest of this year at least. If we have a pullback coming, it's because the market may, over the next month, disappoint with earnings.
That's the only thing, Chris.
Have been really lofty, and if we don't
like the bears, the case for bearishness on the macro right now is just hard. Like, you got rate cuts, you got a labor market that's still strong but cooling off. You got a consumer you could point to weakness in the consumer. That's a good macro point. But really, to your point, even that like consumer feeling is going to show up in earnings, and that is the question. That is the only one that I see where you maybe see a little bit of a red streak in the second half at all would be earnings disappointment. I mean, that's the only thing I think that, because we've seen economic data. I mean, it didn't even matter this morning what retail sales did. The stock market stayed. It wasn't going to get bothered by that. And CPI and these macroeconomic stats that are coming out, it's almost just like not even phasing the market. The market's just rip your face off rallying anyways. And I agree with you. I think the only thing that slows down this market, and I'm not saying this is what I think is going to happen, but the only thing I think that could actually give it a gut punch would be poor earnings, specifically from the big names. The market, I think the index level, I mean, if you get Microsoft, Apple, Nvidia, if they all just have another knock it out of the park earnings cycle, I think the whole market just keeps going anyways. But if those start showing signs of weakness, the index level, obviously the weightings in it, that's going to be the tough one. So we'll see. We're getting closer to that, Chris.
Yeah, so I'll be pretty protective. Like this rip on the Russell is fantastic, and it's adding up very quickly, and it's kind of compounding from some of the positions I built over this year. But I'm still very aware of those highs. If the Russell hits highs and all-time highs, and all of a sudden we're seeing that the SPY's not going higher, the Q's not going higher, I think it's a good time to still be protecting profits and position accordingly. It's like, I think right now I'd be happy moving forward with, okay, get a good, nice catch-up trade on the Russell. It maybe helps me generate 3, 4, 5% for the portfolio. And, the broad market still remains like the same. We're up, 17, 18% for the year. Looking back historically, it's like, this is the best start to any election year that we've had in history. This is the top 12 performance of the S&P all time. The only, in the last, let's say 20 to 30 years, the only year that's been better than this was 2019. 2019 did stay positive. I think it was up 19% to this point of the year, and ended up going up to around 28%. So I wouldn't be surprised if the markets are capable of, the S&P at 22 to 25%, maybe higher, but that would be a stretch. I mean, it takes a lot for the S&P to go 30%. The NASDAQ can stretch 30, 35, 40%, but the S&P get up 30% for years. It's pretty tough. So anyway, I'm staring at NVIDIA here. I still have a play on NVIDIA. that is out to the end of this month. It's out to August 2nd.
It's a credit play, right? Like you're making money if it doesn't go down, but
Nope,
you
it's a debit play.
okay.
I
Debit
decided to
play.
do some vol. So I've got some ratio spreads for credits down here. And I've got some bull put spreads for trades. I've got broken wing butterflies. I got lots of credit trades down here for profit.
Yeah.
But it's a debit play, which is a 126. And I'm looking to either see if price will retest highs or start to break lows.
Okay.
So, I mean, I think there's enough, week to week volatility to give me some direction, but we haven't really seen much of it outside of this kind of squeeze and in contraction and volatility. So,
Chris, I would love to see Nvidia have a gut check to its earnings so
me
we
too.
could buy it.
Yeah.
Because then, do you still have that? I think you had like a put that you had sold out to like 95. Do you still have that play on
Yep.
Nvidia?
I do.
You do have that one.
I'm sitting here at I've got a 100/90 ratio spread,
That's it. Yeah.
and I have a 95/90 ratio spread, and I have some just naked puts at like 85 and 80 as well.
And that one was the credit one, right?
Those are all credits. That adds up.
That was
Where
what I was
even
thinking. Okay.
even if I'm wrong on this debit spread, I have enough credits added up here that
Okay.
I'll still net profit on this. And I'm happy to own Nvidia. Like at this point, if we come back and have a healthy correction to 100 or 90, it's like I'm going to be willing to take ownership. I'd like to say I'm going to own it cheaper than that, but that's about going to be my break even. But the nice thing is the premiums are so rich on this that within a 30 to 45 day cycle, I can probably lower my cost basis by $5 on Nvidia. Now, I lower my cost basis. If it starts to rip, I might repair it and not necessarily catch all the upside. But to me, I think it's a pretty straightforward stock if I own it to know that I can at least lower the cost basis, get it called away for profit.
Yeah.
Very easy.
I want to real quick. I want to ask or answer a question here in the chat. We had a really good question today.
Yeah.
Any particular reason why DJI, which is the Dow Jones, is
Yep.
so bullish right now with the S&P and NASDAQ down? I wanted to show my screen for just a second just to answer this question because that is a good question.
Yep.
We've seen the opposite be the case for so long. We've talked about it a lot on the show where the NASDAQ was up every day, the S&P, and then the Dow's just been underperforming. Dow is making a huge push. Really, really good day for the Dow and for the Russell, which we've just talked about for several minutes here. Why is this diverging? Why is the S&P having a flat day, NASDAQ's down, and the Dow Jones is up? Well, I've got a sector, a sector part of my watch list just to help answer this question. So I know it's a little bit small. In fact, let me see if I can zoom in for you guys. So check this out. I've got on my my ETF watch list here on TradingView a sectors section. And we've got a little bit of everything in here. So the XLs, I trade these guys a lot. So the XLs are sector ETFs. So we have things like XLI, which is industrials, XLV, which is healthcare. We have XLB, basic materials, XLF, this is financials. So what we see here is, remember that the NASDAQ is more tech heavy, right? So the technology heavy stuff is actually doing poor. And you can see I'm long the XLK, which is, I'm taking on some water here today on my position. But XLK and semis, SMH, which is like NVIDIA, which Chris and I were just discussing. So we see some selling of those areas. IGV, this is a technology sector ETF. So, my point with that is you've got a couple of the tech heavy stuff doing not so hot today. And then on the other side, what's doing well? Well, regional banks, which is a big section of the Russell, doing really well today, up 3%. Industrials doing really well today. XLV. These are, by the way, some of the more, XLV is more of a defensive sector. So to see that leading is interesting. Basic materials, financials. What this would suggest to me looking through this, industrials, healthcare, financials, and basic materials leading, that would tell me that the market is saying, oh, so there's going to be an economic kind of expansion period because these things are very correlated to the health of the economy. Industrials, basic materials, financials, especially, these things do well. And not to mention real estate, but that's very rate sensitive. So that's why you can see at the index level some divergence in performance. But just wanted to clarify because I thought that was a good question in the audience. Chris, do you have anything to add to that thought?
Yeah, well, also to add to that, what is inside some of those sectors? If you look at, I think a big comeback story has been UNH, which has been like healthcare has been dragged down lower. The Dow is also not market cap weighted, but it's price weighted. So it's
Yeah.
essentially,
Yep.
all of the undervalued, underperforming has now had a nice injection in the last week. And so I just think you've got some big movers that are recovering quickly, and price weighted is a lot different than market cap. I mean, and again, we've talked about this, like for a healthy bull market, we should see everything moving kind of in unison, right? I mean, we saw the S&P carve new highs, the Qs carve out new highs, but the Dow was lagging and the Russell was lagging. Well, now
Yep.
the Dow is up, now the Russell's up, playing some catch up, which might help them get back to the levels of, okay, SPY's up here and Qs are up here. Now the Russell and the Dow can catch up, and then we'll see if collectively could they all go together. Could we return to that kind of broad bull market, and give it a chance? So I think right now we're witnessing the catch up trade, and then we're about to see if we can catch up and also steam ahead, and kind of have a little bit more drift to the upside with all of the indexes still making higher highs.
Yeah.
I wouldn't be surprised. I wouldn't be surprised if S&P eclipses 20+% for the year, and the NASDAQ gets back up to 30+% for the year. Just, again, give the Russell and the Dow a chance to catch up, and that's a great year. I mean, my gosh, you can't ask for a better environment to be long when everything's up, and it feels. Certainly not every stock is up. I mean, right now, only look at Nike. You got a household name that's down 50+%. So it's not like every stock is performing well,
Sure.
but you're given at least a bigger slice of things that can perform and can carry the weight. And so it is nice to see for the first time in months, like small cap matters again. And maybe
Yeah, it is very nice to see. Yeah, and
everything's been over.
RSP, IWM, yeah, it's just nice to see other things performing. You also, as we've talked about today, people are asking about gold as always. Everybody loves their gold.
Yep,
Gold is tapping on the door as we speak to an all-time
that is
nominal
impressive.
high. So,
Yep.
and just how quick these things can move, man. Same thing with the Russell, gold, Russell. When you get a true, change in secular thinking in the market, things can change quick. I think that there's a little bit of somewhere in here, not to be contrarian or negative, but a little bit of concern about the future here too, because you do have, I know yesterday the VIX was up a little bit. You also have healthcare as one of the top performing ETFs, which healthcare sector, XLV is healthcare, and healthcare is generally seen as a less, it's more of a defensive sector than the other ones, not always, but we see a little bit of outperformance in some of the more defensive names recently. Gold is up. So there's a little bit of that going into the picture too. Maybe the election is giving some jitters to the market. Still just a question of what's going to happen geopolitically if Trump is back in office. There are just these questions. So anytime there is uncertainty or questions, it can cause some big moves. And we really see the change in tech being up every day and everything else being flat. We finally see a little bit of rotation come into the picture. Also, Chris, we've got Frankie's going to join the call here in just a moment. I'm going to step out here and let you guys battle it out for a little bit here. Take a look at some charts. Question for you as we jump into this. We got Netflix, I think, on Thursday. I'm wondering if I'll hop out, but I'll be listening if you have any thoughts on earnings season, which is starting up for plays. So, Chris, thanks for coming on. Before I step out, everybody who would like to see more of Chris Pulver, he's got his own social media accounts. You can find him on Twitter at Real Chris Pulver. You can find him on YouTube, Chris Pulver. Just search his name. Keep up with him there. And you can also find his Discord channel as well. So, Chris, thanks for coming on. You've got the show for a little bit.
Thanks, Nick.
All right. See ya.
On that question that Nick just asked on Netflix, I think I placed this trade with the show yesterday. Frank, were you on with me yesterday doing Netflix, or did I do that in my trading room? It's all kind of boring when I'm live like 5 hours a day, but did I not do it with you?
We didn't get to stocks yesterday or earnings plays.
Okay, so I do have an earnings play on Netflix, and this is what I did. I told you last week that my earnings season is I'm going to play quite a few. We can price out a couple today actually and see if anything looks good. But for Netflix is one of the potential movers. It's an expensive trade. Well, I should say this: if you're looking to just take a direction and you're doing it with a debit, it's going to be pretty expensive. I looked at this yesterday. It's it's a $30 debit if you want to just trade an at the money straddle or an at the money strangle. So that's not what I'm interested in doing. But instead, I'm just doing around the expected moves, which should be about $66 to $80 is my expected move. I want to say that if I go out to the 7/26 Friday expiration, that's next Friday, not this Friday. Earnings comes out Thursday after market for Netflix this week. So if I go to earnings this week on Netflix, it's after market Thursday the 18th. So if I want to go to this Friday's expiration, that means I only have 1 day to manage it. Frank, is it your birthday?
Yeah, it is.
Happy, dude. That's awesome. Happy
No,
birthday,
don't
man.
sing, don't sing.
Nothing. All right. That'd be two times I'd be singing today if I busted that out. So, dude, happy birthday, man.
Thanks.
All
Is
right.
it? Oh yeah, I heard you singing a little bit earlier on. I didn't know you had so much soul in your voice.
Dude, I just wake up with soul every day. I usually just, sing in the shower like, nobody's listening. But today I felt like it's time to let the cat out of the bag. I really aspire to be on American Idol. I'm kidding.
You should try.
All right. Netflix. So the expected move calculated out, I think I like going through this with you. We've done this a lot on the show. I'm going to go into my software here for Option Slam, and I'll price this out with you. So we did Netflix yesterday. I put in the trade. It's credit spreads, and they're in the monies. And so I did this pretty conservatively. If you look at earnings on, that's a sweet visual. If we look at the last like 10 earnings reports, you can see, 10, 18, 18, 20, 17, those are some big blowout expectations. But then we kind of went back to more realistic, like 9, 9.4, 9.9. So I calculated Netflix with the average is 1288. I did a 10% and I did like an 11 and 12. So 10%, 11 and 12%. And I want to see what those moves roughly were. So we're trading at 655. A 10% move in Netflix would be a $65 move. Okay. That's roughly what the Ivy rank was and the IVX was, and Tasty's platform was about a $60 move. It actually was slightly richer. It was like $70, and I calculated like 66. So on the conservative side, I would say $66 would be expected. On the blowing out expectations moves, better, for good or for good or bad, $82 would be. I mean, if we moved $100+ in Netflix, that would be fantastic. But realistically, if I get a $60 to $80 move, that's how I played this. And so yesterday, I was basically, the stock price was sitting at 660, and so I went in the money by $60. And so on my bull put spread, I sold the 720 and I bought the 715, and I collected about $3.75 credit. Okay. And then on my call spread, I did a sell at 600 and a buy at 605 and grabbed another 375. So my total credit on the trade is 750. All right. Now 750 credit on a $10 spread, I'm only risking $2.50, but I'm trading both sides of the trade. So here's how this works. If I win on one side 375 and I lose on the other side $1.25, what's my max gain? $2.50, right? So that's the most I can make on the trade. This is the most I can lose on the trade. So I'm okay with that. Like I'm standing to make, 2 to 1, however this shakes out. If I make money, it's going to be roughly, 2 to 1, but that also gives me some wiggle room where I can go after a 1 to 1. And I would say that if I'm up $125 per contract, or I'm up 1.25 credit per contract, I might just take the profit and move on, because with a 750 credit, let's just say that I can make $1.50. I can max my risk. $1.50 divided by 750. That'd be a 20% target. I think that's pretty.
These are credits. So you're selling bull call verticals above price, right? And then selling bear put verticals, or I don't know the names of it.
Other way around.
Yep. I'm doing puts above price and then calls below price.
Yep. Puts above and calls below. So I'm in the money on the puts and I'm in the money on the calls, which means I get a lot more premium for that trade. Now the risk that I take on is there is a risk that if the market, dumps to the downside, I might get assigned the shares, which I will just repair because it's a defined risk credit spread. So I can use the long side of the trade to close out, take the same risk off. So however it shakes out, hopefully there's no assignment, but if there is an assignment, I'll repair it and just get rid of the losing side and then take profit on the profit side to be a net profit of, maybe $1.50, $1.75. Max profit is by next Friday. So if I want to sit in this trade, until next Friday, I could make $2.50 would be my max profit. So that's what I could do. I'm just taking, I'm just taking, simple credit spread. Let's maybe look at a couple other ones today. I'd like to look at, so if I look at Wednesday, Johnson & Johnson's kind of interesting to me. It's not a big beta stock. It's not super volatile.
I don't like any of these, to be honest.
Okay.
I don't like banks.
No, I mean, banks are boring when it comes to earnings plays. Domino's might be okay. Netflix is probably the better one. I mean, I'll look at it this way. If I take, and maybe this would be a really easy way for us to talk about earnings and for me to play earnings this season. If I just look at the big ones, like I'll do Netflix and Meta and Microsoft and Google and Tesla and Nvidia, like I'll look at, the Mag 7, the top 10, and just trade those in the money credit spreads where my risk parameters are really tight. I mean, if we beat earnings, great. If we miss earnings, I think that's where a lot of damage comes in. If we're talking about this correction and this downturn in the market, it would probably be with a disappointing earnings season. So I don't want to pay a lot of money for those earnings. I've been pretty fortunate this year that for the first 2 quarters of trading, I've had about 72% of my earnings plays have been positive, more reward than risk. We're up about a net like $5 or $6 on just earnings alone, which isn't actually no, like I'm sorry, $40. It's like a net $40 of credit, so not bad. Anyway, it's all good, and I'm just thinking Netflix is a good one for this week, but I do want to take a look at some prices. Alcoa has been Alcoa has it's a very moody stock. I mean, when we seem to have some risk appetite, Alcoa does really well. I own the shares of Alcoa. I've got a break even in the low 30s. I started buying this thing, low 30s and kind of scaling into it. I do have some options. I'm covered up to like $45 or $50 on Alcoa. I'd like to see it still go up. I don't know. I say this is volatile, but the weekly average is about $3.74. So this is probably a terrible earnings play. Let's go to Domino's. DPZ, is that right? Yeah, Domino's is
that this week?
It's this week. Domino's is Thursday before market. So this is one I'd like to take a look at. So Domino's is not quite to all-time highs. What else?
Abbott Laboratories, ABT. That's another
you
one.
made it on that last time.
What
AB, what is it? AB. What's the symbol for it? ABT. Okay. 103. All right, let's take a look at both of those. So let's go ABT, and then we'll do DPZ. So ABT sounds like I just can't say my alphabet. ABT, DPZ. I'm a kid that has a learning disability. ABT.
I think ABT is not going to move. So I'm thinking you could do like an iron condor on that, but what would it be to the sell side?
So you're talking about kind of you're trying to go to the outside of the expected move and sell that premium.
Yeah, I wonder what that would be like.
Let's price it out. So it's $100 stock. We're looking at an average move of about 4.48%. Looking at the last 10 earnings, we do have most of them in the 4s and in the 5s. The last 4 prints have been over 5%. So again, I'd say conservatively 4.5 looks pretty good, 4.48, and the move is at 102.98. So we'll take 102.98 times 4.48, 0.0448. That's 4.48%. And you're looking at a move about $4.60. Okay. I don't have my Tasty platform up and running because I was getting some buffering in the stream, so I'll keep that aside. But I'm gonna get this all priced in. If I take the trade, you and I can chat more on Discord. But I will look at this trade. So 448% move. We're looking at about a $4.60 move. So Frank, do this for me. If your screen is up and running, let's create the trade through your platform. I just want to see what it looks like. If you wanted to go out, let's say like maybe $6, $7, and maybe look at that as if you're doing an iron condor, you're looking to sell a call up here and then sell a put down here and then turn it into a spread, and you're trying to collect that premium. Now the question for you is, are you going to trade an iron condor and go both directions, or you want to be just one side to think of that Abbott is likely going to have solid earnings and we go up? I mean, there's also that lean of, look, the Russell's up, the SPY is still at highs, the Qs are near highs. The markets are playing catch up with the Dow and the Russell, but the NASDAQ and the SPY are still at all-time highs or close to it. I would be leaning a little bit more towards, if we have a positive print, things are going to be pretty good and steady. I wouldn't necessarily love taking a bunch of downside trades and earnings. I think that if we're steady and hitting expectations, the market's going to be pretty stable. But I think, selling premium or selling options in this earnings season could be pretty good, just because maybe we have less than stellar directional moves, but we have stable moves. Does that make sense? Stable would still allow you to make money, right?
If I built an iron condor, on the put side, you're buying at 97 and you're selling at 102.
No. Well,
here's what I was going to say. It's
okay.
It's close to $3 credit. So
okay. So if you're selling at 102, so are you selling at 102 or are you buying at 102? Because if you sell at 102, you're doing a short strangle.
Selling a put at
102.
Yeah, selling a put at 102, buying a put at 97, selling a call at 103, buying a call at 108. That's selling an iron condor.
That's selling it. Yeah. So you're doing the sell on the iron condor, which means that you still want to see price stay within. So that iron condor is going to be constructed this way, right? You're going to have your risk, your reward, and your risk, right? So you're collecting credit at the 102, 103 area, and you want to make sure that price does not go too far to the downside or too far to the upside. So what were the legs that you were selling? You said 97.
Yep.
Okay, so 97.
That's a buy. That's a buy.
Yes. And that just creates a spread. That's just defining the risk. That's no big deal. And if you went from, you would sell the 102 and then buy the 97. So that gives you this is a $5 wide condor for the puts. And then what about the calls? Are you only doing one side or are you doing both sides?
Both. You sell at 103. So
sell the 103 and then buy the 108?
Yeah.
Okay. And that would be a $5 wide condor. So net, what are you collecting on that for the total credits if you put all four legs together?
It's on the low end, it's 272.
Okay. Your mid price is 272?
The mid price is 282.
All right. So we'll just say 280. All right. So that trade, if taken, you're getting 280 and you're risking 220. Okay.
It's almost 1-to-1.
Well, it's slightly better than 1-to-1, which is nice. And that's pretty favorable, because most of the time it's hard to get a favorable reward to risk when you're selling options. A lot of times you're selling options, you're usually getting about 30% of the spread, 40% of the spread, unless you're going in the money. So at the money, this is a pretty solid trade. What ruins this trade is a beyond expected move. So we're planning on this market moving about $4.60, and you're going $1 up and $1 down to create those spreads. Okay. And so down to 97, if we have a $4 move or $4.60 move, it's not breaching 97, which is good. And it's not breaching 108, which was good, right? If we go from 103 to 108, that's, it's not going to get to 108 if we're moving only $4 or $4.60. So again, I constructed this where, like Frank's telling me, if you have this as your profit, okay, this is what the trade looks like. Price would have to go beyond. You'd have a trade here, Frank. What's kind of nice is your break even is actually from 108 to the upside. your break even is actually like 110 and change, and the downside, your break even is around 95. So you have from 110 to 95. If price stays within that window, you have the ability to at least make a break even trade or make some money on the trade. So ideally, you want it to stay below 108 or below 108 or above 97. That's where you're going to collect your full 280. And for the safety of this trade too, if you take this position, and what expiration were you looking at? Was this out to the 26th?
This is Friday.
This Friday. Okay. Okay. So, and I mean that I kind of prefer to take it out to this Friday because you only get like 1 or 2 days to manage it. And so if we have a very lackluster, low directional move, and you can just quickly take that time premium and get that decay right away, that would be perfect. And so,
but you said the other day that you like time in your time decay. You said you want more time.
No, I like the premium with more time. If I go out further in time, I expect to make more. So go out to next week and see how much more credit you make. You'll probably make another 30 to 50 cents on the trade.
Okay.
Go out to next week and do the exact same trade, change the expiration to next Friday the 26th, and tell me what the credit is.
Okay. Give me a sec.
Okay.
So, yeah. I mean, mid price is 304.
Right.
So you're right, 30 more cents.
Yeah.
But I don't know if it's.
But I don't. In that case, the 30 cents to me isn't worth it when you can have such a quick decay this week. So I mean, if I'm taking this trade, I like your approach of this Friday. I think that's a better trade.
Cool.
Yeah. So I think
What
this
about
is a good trade.
What were you gonna do? Dominoes.
Dominoes, DPZ. Yeah. Take a look at that one.
You're hoping for like a wider than expected move.
Well, it depends. I mean, Domino's is a what? I mean, DPZ is a $480 stock or something like that. We're at 488. So the expected move for the week is about $24.80. The average daily trading range is 12.24. I want to see it. Is Domino earnings? Is it big? Yeah. I mean, we've got 8, we've got 10, we got 6, we got 8, we got 9, we got 8, we got 9, we got 7, we got 6. The average is 6.64. I would say that's a pretty conservative average of Domino's. And so let's go 6.5. Okay, so I'll take a 0.065 times the price, which is 488.09. So I'm looking at about a $31 move on Domino's, and the average weekly move is around $24.80. So again, conservatively about $31 expected move. Okay, $31 expected move. What's the beta on Domino's? Beta is 0.92, so it's not greater than 1.0, but we're going to get a decent amount of volatility, probably close to expectations. So again, Domino's is a bit expensive. Here's probably what I would end up trading. Frank, if you do, so current price is around 488. Let's just call it 490. Can you price this in for me on your options platform just to see what it is?
Yeah.
If you were to sell a 520 put
for next Friday,
for next Friday, yes. So go out to the 26th, okay, and then so 7/26 expiration. Sell the 520 put, and what's the closest strike to that? Is it 517.50 or is it 515?
The closest strike.
Yeah. So if I sell the 520 put, what's the one strike away from that to buy? So if I'm going to create a spread,
515.
515. Okay, so I would buy the 515. Okay.
Okay, so you're going to do an out of the money,
in the money bull put.
Oh, yeah, in the money put. Okay, so that is 425 mid price credit.
Beautiful.
Yeah, so if you're doing 10 contracts, that's $100 risk and $4,900 reward.
That's not necessarily true. You'd have 75 cents risk. You'd have, like, if you did 10 contracts, you're taking on $750 risk, but you're making over $4,000 if you're right.
Oh, hold on. When I put in mid price, it's 42.50 max profit. Max risk was 750.
Yeah. So, okay. So maybe, and that might be tough to get filled at 425. That's probably beyond the expected move. So do one more for me. Do move the sell put down to 515, and then move the buy put down to 510. Is that still trading around like 350 or 375?
The spreads are super wide. Mid price is 315, but the ask is 720 and the bid is negative 90 cents.
Okay. Those are crazy wide. So here's why I would do that. If we did an expected move of around $31, this allows the $31 move. If we're at 490, we go up $30. This allows this trade to be in the money and actually have price go high enough where price is trading at 520 and it's greater than my strike prices, which allows me to actually take here's what I was going to say. If this could be instead of, we're not going to get $4 on it most likely, but if we could get maybe 350 to 375, if I can get that for the credit, I would say that trade is worth the risk, because if we go to the expected move and we're basically we're putting the trade in the money. If price goes beyond our strikes, we're now out of the money, which allows us to have our options finish out of the money, which is how we get paid on the trade. So if I could collect 350 to 375 on this, it'd be a bull put spread 515 by 510. Now to the flip side of that, we would go $30 lower. So from 490, look at selling. This would be a sell the 460 call and then buy the 465 call. Are those the correct strikes?
So the 460 call.
Yep.
And then 465.
Yep. And then buy the 465 and see if that's trading for. So if you do all four legs together, we should see this trading for like $7 and change. I would try to get like $7 or $7.50.
Yeah.
Very similar to what I did on that
price. If you get the mid price on this, it's 350. So it would be around 7 if you took the other one as well.
Okay. So if you could get filled for $7, here's how the trade would work. If price goes up to 520 or goes down to 460 or even gets close to those levels, the $7 credit could likely trade for a $6 debit or a $5 debit. And that's how I'm going to make money on the trade. I don't necessarily need to capture, all the credit, because I'm taking both sides of the trade. So I'm not going to actually make $7 on the trade. What's going to happen instead is if I win 350 on one side, okay, that'd be my win, and I lose $1.50 on the other side, my net profit is maximum at $2. So $2 is my max profit per contract. So that means that of my 750, my max profit is going to be a 550 debit, right? And again, if some of you out there are watching this, you're like, what are you talking about? This option stuff is so confusing. It's really just addition and subtraction, okay? If I've got a 750 credit and I close that for a 550 debit, I still make my $2 profit, okay? But that is my maximum. If I want to get out of this trade with a higher probability and not have to wait until the 26th expiration, I could say that if I max out at $2, but I can show this making $1, or I can show this making $1.25, or I can show this making $1.50. To me, that's good enough, and I would just get out of the trade. So if Domino's does what it's expected to do, get to 520, get to 460, one of these trades shows profit, you take your 750 credit, close it out for 650 debit or $6 debit, take the profit, move on. And that's it. Okay. So I like Domino's in that respect, and that's probably what I'm going to do for most of these option trades for this season, which is going to be if the expected move is up there. And one more thing we want to look at here is how often do we hit like 6% or 6.5% Domino's? So let me go into post earnings. So how many times did we hit it in those 8-day cycles? 6%. So this one was 6.25, but didn't get to 6.5. But it's right around expected move, which is okay, but I'm going to cross it off. This one gets there on the jump. This one does not get there. This one does not get there. This one does get there. This one gets there. This one gets there. This one gets there, and this one gets there. So out of 10 earnings, you have 6. So you have 6 expected moves, and you've got 4 no's. So to me, that's a good enough probability that Domino's likes to deliver pun intended, I guess. It likes to deliver at least unexpected earnings, which makes it pretty reliable for a way to craft this trade. So I think it's a good play on earnings for, again, not super expensive, pretty cost effective. You're lining up a favorable, reward to risk, and in this case, time is actually on your side out for the next week. Which
Let me know how it goes, because I will probably not participate. I can't run the risk of getting assigned
Yep, I
without
understand.
unless I just don't want to trade for like 3 days or something. But
You
yeah.
said you also don't want to trade for 3 days?
No, I mean it'll restrict me for like 3
Oh, I see.
days
Yeah.
for them to clear the margin call.
Yep, I see what you're saying. Okay, that's fair. All right, let's take a look at one more. So Domino's, Abbott, I did Netflix, Halliburton, Schlumberger. I'm curious on those. I don't think there's any other big ones. Let me check DHI. Home builders. Whew. This thing has moved so much prior to earnings that I don't think I want to touch this one. Wow, that's a crazy trade right there, man. Are home builders like doing this all over the place?
I don't
Wow.
even know what that is.
Well, DHI is a home builder. I mean, this is like Pulte, Lennar, Toll Brothers. This is like a manufacturer grade home builder. I mean, the stock has ripped 17% in the last like 4 trading days. So let me see something really quickly.
It's already moved so much. I'm looking at American Express.
These are ridiculous, dude. Like Pulte Homes is up 17, 20. This is insane. Like I didn't even know these stocks were I mean, these are 17, 18% moves since last week.
Either
I guess I know why.
Later.
Why? Probably because you're cutting rates, and it's going to help home builders because more people possibly buying the supply that's on the market. I guess. Man, this is look 25 basis points out of a 30-year mortgage is not that big of a bonus. It just means it's the sign of things to come. But that is a crazy aggressive rip right out of the gates. Like so, I'm assuming that Lennar is doing the same thing. Lennar.
Look at AXP.
All of them. Yeah, that's crazy. All right, AXP, American Express.
Yeah.
Okay.
This has so last earnings was about a 10% move.
All right, let's take a look.
Earnings before that was about an 8 or 9%. This week alone, it's up. That's crazy. I don't know what's up with AXP. They're up almost 4% on the week.
I see that, and that's another thing that I'm a little skeptical of is if we're already starting to see some pre-earnings movement. Not that it can't still deliver in earnings as its own catalyst, but I don't really like to see aggressive movement prior to earnings, just in case it's like maybe the earning size gets capped because it's already made a move on the week. Are we sitting at all-time highs here in Amex? I think we are. Yep.
Yeah,
we are. All right, let's just take it for what it is. Let's price it out. So AXP, we're looking at about a 6.5% move. It's pretty consistent, right around that 6 to 6.5% is pretty safe. We've had some, and this is a nice thing, is the average is showing them on 6.5%. We've had some 7.5%, 8%, 8.38, 7.5%. So let's say we calculate our trade out by 6.5% earnings, and it actually gives us, 7.5% to 8%, or like you just said, 10%. That makes this even easier, as long as we, kind of reach those expected moves. So anyway, let's price it out with, let's go 6.5%, and we're at 247.88. So 247.88 times 6.5. You're looking at about a $16 move conservatively. Okay, $16 move expected. Oops, go text box instead. So $16 move expected. What are the spreads on AXP, Frank? Are they dollar spreads? If I went up to, let's go 248, okay? So 248, let's go up $15. If I sell at 263, is there a 263 available, or is it like a 265, 260? What are the spreads?
262.5.
Okay, you have a 262.50, and then you have a 265?
Right.
Okay, so I would look at if I sell the 262.50 and then buy the 260. These are puts, by the way. So that's a 260 put and a 260, 250 put. And that would create a spread. So your spread's 250. Frank, can we collect like $1.50 to $1.75 on that trade?
They changed drastically just now. It went from 260 to 160.
Okay, that's about right. I mean, you're not going to get, look, if you got a 250 spread, you're never taking more than 250. So I'm looking at this as anytime I'm selling in the money options, I would love to get 70% of the premium or better. So that's usually my ballpark. If I get,
that's a good one though. 168 is the mid price.
Yeah, so 175 would be 75% of the move, or I'm sorry, 70% of the move would be a $1.75 credit. So if I would accept probably $1.65, $1.70. It's a little bit less than what I want, but ideally I'd like 175.
You probably wouldn't get it though, because the bid is 25 cents and then it goes up to 3.
It's wide again. Yeah, it's super wide. So this is how I create the trade. I put in $1.75. If it gets filled, awesome. If it doesn't, I'd probably try to get filled at 170. If it doesn't, I wouldn't take the trade. That's all.
Hold on. Let me look at, you go 257.50 and 260. Actually, let me see this. So you go closer to price and let's see, we're selling puts.
Yep, you're gonna sell the farthest price out. So if whatever your higher price is, that's the one you're selling, and then the one that's closer to actual price, you're gonna buy that one.
This one's better. The spread is 145 bid, 178 is mid price. So this is for next Friday. If you do 255 and 257.50, that's closer to the money, and it's more credit somehow.
So you're telling me that if you sell the 257.50 and you buy the 255, that you can get $1.70 on that?
$1.78.
Okay.
Oh, just change the $1.42.
Okay, that's not surprising. Okay, so I probably would have to go to like a 260 by 257.50 or 262 by 260. Again, you gotta play around with it. There, in the money like that, you might have to, you might be dealing with some lower like open interest levels. But again, if I'm looking at it this way, if I can't get filled for around 70% of the credit on the width of the spread, I'm not going to take the trade. So I don't settle for like, I'll go 50-50. No, that's not good enough. If I'm going in the money, I'm taking on a little bit more risk where the price doesn't necessarily go to the expected move. But the nice thing is my reward to risk is favorable. I can win one side, lose one side, make net profit. And that way, the hardest thing in earnings is to pick a direction, because every time you pick directions, I mean, it seems like, if all I did was buy NVIDIA, I'd make a bunch of money. Well, it's not necessarily the case. I mean, at some point, like, I don't know, I like to trade options both ways where I can carve out profits either direction. Nick, what's up, dude?
What's up, guys? Can we just take a second to hold on? Let me share my screen. Can we just take a second to I'm gonna throw some compliments out here to each one of us. So I mentioned Sly G. You guys can see my screen. This is just a crazy day. Look at this.
I know.
We got the Dow Jones up 1.5%. The Nasdaq's in the red. The Russell's up 2.5%. Frank, I know, is long. Sly G.
Sly G.
The cool name, Sly G.
I bought it because of Gus, my dog.
His dog's name is Gus.
He's a Sly dog.
He's a Sly dog.
I mean, look at that thing. That thing is absolutely flying today, up 2%. You've got gold. I'm long gold, and I know Frank is also long gold. You're long gold as well, Chris. Same thing with silver. We finally have got some real interest rate sensitive stuff just having its run, which is exciting to see. Got yields dropping off real hard, and it's becoming a little bit more convincing that we might actually be having a real rotation here into other things. I mean, how can you deny it with the Russell up so much? And we talked about the sectors earlier, but gold up 1.4%, and that's not off of its lows 1.4. That's at the highs of 1.4% today. I mean, these are real moves happening. And It's big stuff. So just wanted to come in here and also mention that you got RSP up 1.22%. It's like finally you've got some rotation here.
This is good. I mean, like I said, the best thing about this, what we're noticing is don't feel like, oh, I'm missing out. It's like, look, we've been participating in these trades all year. So getting the fact that, I mean, the Russell is the catch-up trade and small cap is the catch-up trade, and this rotation is real. And what's kind of crazy is you could still see the SPY and the Qs still make all-time highs and still keep carving out all-time highs, but money is flowing into these undervalued, underperforming areas. And that's what's nice about this, is this truly is kind of injecting the health back into a bull market, which is pretty exciting, to be honest.
No, it's a good thing. I mean, that's been one of my biggest concerns, has been the narrowness. And it's like, finally, we've got some breadth to this rally. And I think that, you know, you're still going to probably get pullbacks and hiccups along the way, but this actually makes me more confident in buying the dip when we see that it's not just technology and that's it. We see, you know, a lot more health to this market, I would say. We're going to shut it down because I got to get Chandler and James's help on a bunch of stuff today. So we got to offload their duties as well as Frank's and stuff. We got a bunch of stuff. But before we shut down the show, let me just thank both you guys for coming on, but also we'll mention it again. If you guys would like to keep up with Chris Pulver, we've dropped his link here in the chat. There it is, Chris Pulver Trading on YouTube and at Real Chris Pulver on Twitter. And you can find Frank and I here every day. Also, yes, look at that. We got happy birthday to Frank. Can we get some happy birthdays in the chat? Hold on. Where's my soundboard? I got soundboard for this. Hold on. There we go. Yeah.
There we go.
Woo!
Is that this soundboard? Is that little John Cena?
Yeah, little John Cena. And that's celebrating Frank's 12th birthday, everyone. He's 12 years old. It's fantastic. Yeah. So,
halfway there,
guys. He can almost trade on his own live account.
The slyest G in the market.
He's the slyest G. Yes, sir.
I like that, actually.
Okay, guys, that's it. Thanks everybody for hanging out with us. Chris, Frank, thank you guys for hosting. And with that said, we'll see you guys. We'll see you guys back tomorrow.
All right.
Thank you, everyone.
Take care.
Thanks for tuning in to today's A1 Trading Show. Make sure to subscribe and to turn on post notifications so you don't miss the next one. Also, we're looking for more guests to come on the show. If you're comfortable being on camera, have trading experience, and you're looking to grow your audience exposure, we'd love to have you on. In the live stream chat and description below, we'll drop a link to apply to be a live stream guest and join in on the conversation. We hope to have you on soon. That's all for today. Trade safe, and we'll see you next time.